Hello, good afternoon, everybody. Happy Tuesday. Thank you for joining us on this new edition of Power Play Tuesday. My name's Andrea Chacin. I'm an IRA specialist here at Quest, and I'm super excited for today's class. I have Chris Carsley speaking to us today. He's managing director of Blue Water Global Ltd. He brings over 25 years of investment industry expertise, specializing in corporate and venture finance, business valuation, business operations efficiency, regulatory compliance practices, security research, portfolio management, arbitrage, trading, and hedging. So lots of experience. We're super excited for him to be talking today to us about assess fund performance like a pro. So without further ado, let's bring Chris up so we can get started. Hi, Chris. Thank you for
Hey,
joining
Andrea,
me.
how's it going?
For being here. Go ahead, please.
Yeah, no, hi everyone. Thanks for joining us. It was kind of funny. I think, Andrea, you read through some aspects that I still certainly do, but currently, a little bit on me, and we'll have a slide on me also. That we can now skip over because I think Andrea did a great job of a lot of my past performance. I worked in both hedge funds, venture, traditional asset management, managing people's money, and then currently founded Kirkland Capital Group and worked and now run a private debt fund. And so lots of different background. And as we're talking about today, lots of different forms of performance throughout my career and having to do things. And I think one of the things I'm going to lean pretty heavily on is my time working for a fund of fund, looking at a number of different esoteric strategies. I mean, literally hundreds and hundreds of them. You really have to put your hat on when you're looking at performance. And one of the key things that I want to drive and the overlying theme here is performance is more than just the return you're looking at. It actually really can tell a story. And so we don't have infinite amount of time because you could run an entire class on this, but we're going to cover a lot of those subjects of how to think about that and how to maybe alter how you're looking at the performance as you're going through and looking at funds for yourself. So let's take a step forward here. As we said, there's myself. We can skip over that because Andrea did a great job of introducing a lot of the things I've done. Today, we're going to look at, why do we look at performance? We all do. That's how we look at funds. Sometimes it's the first thing you look at, which actually can be a problem because you can, what they have you can be led off a cliff by performance. And some of the things we'll talk about will give you a better idea of what I mean by that. Types of performance numbers. There's lots of numbers depending on what fund you're looking at, what the fund is doing, what type of investment structure. You may be going from one fund to another. For instance, you may be looking at a hedge fund, a long short hedge fund in one instance, and you're interested in venture. The performance numbers and how you need to look at that are totally different. And here are we'll walk through all these. These are the various aspects of how, when you're looking at performance and doing analysis of performance, you got to think about the measurement, the attribution, the ending analysis that you'll see comes from that effort of doing measurement and attribution. And then we'll talk a little bit about benchmarks and then something that came up earlier this year where obviously I was at a real estate conference and they talked about the triple net return, not triple net return as in like some type of commercial building you're in, but the triple net assessment of returns in today's age of inflation. So why do we look at performance? Well, we want to understand the historical capability and the skill of the manager we're looking to deploy our money to. That's the primary. That's where everyone really looks at it and says, great, has this person performed? But it's deeper than that. And you can be led astray, and there's a number of things that can occur. You need to understand the repeatability. Have they been consistent in their return matrix, depending on, like I said, whether they're venture or they're private debt. Private debt would be something that you would see as assets grow in the fund. Their performance has been pretty consistent. If they're a long short hedge fund, you might look at, well, how have they been in the cyclical pattern of markets? Have they been able to match their say and do over time? That's one thing that we can pull from performance, and that's what we want to do. Does performance match the investment strategy and objective? This gets a little bit deeper. And, we'll talk a little bit about what I mean there, but you want to understand, wait a second, they told me they're doing something. Does that performance meet the returns that I'm seeing? And that's a little bit deeper than I think most people look at. Next is kind of down the same idea, but not so much the performance numbers, but maybe the volatility of their performance numbers. You're looking at the risk assessment. Is like, wait a second, the variation of return or the movements, is that in line with the risk they say they're taking? So these are the kinds of things that, this is why we look at performance, but we can take it an extra step. And like I said earlier, there's lots of different performance numbers, and even they are malleable. So you really have to dive in. And any manager or any fund's going to have a series of performance numbers. You need to really have them walk through how you calculate it, who's calculating it. Is it done internally? Is it done externally? Am I looking at a simple return? Which is just a summation of returns over a period of time, say month to month. Am I looking at a compounded return? Does the fund have the ability to compound their returns? So let's say in month one, I have a $100,000 investment. I make $10,000 in that month. And the next month is my new balance, $110,000. So now I'm going to have a new starting capital balance for the next month, which would effectively create a monthly compounding. So understand what type of number there. Are you looking at an annualized return? And that can get kind of tricky on how they're calculating that. So you should understand how to calculate an annualized return. So you understand, as that manager shows you that type of number, what does that actually mean? And I'll give you an example there of where, we may have a partial period of where I'm only looking at 8 months. Well, they may show me an annualized return of that 8 months. Well, the problem with that is that can be a little bit forward looking. We don't know what actually is going to happen for the next 4 months. And they're just taking a guess. If I stay on this path, this is what my return would look like. And then, is it a total return? Am I looking at, both principal and income or any other source of return that could come from the investment? Or am I looking at a piece of it? So those are the various types that we can think. And there's some more here that I'm going to run through really quickly. You might see this a lot in performance where they show a trailing return. Okay, well, what is that? Well, often that's used in, you'll see something like a T12. Well, that's a 12-month trailing return. So let's say we're in February. Well, they're looking at the return from 1 February to the previous February. So you still may be looking at 12 months of returns, but it's not a calendar year. And that's very common as you migrate through a year. Some funds will show that, that trailing, or some people T12 or T6 or something like that. This one's a pretty tricky one. You'll see this a lot if you look at venture, and sometimes in real estate, the internal rate of return. And you can Google this and you'll see people who are proponents of it. You'll see people who, look down on it and say, hey, it's misleading. But get into your head. It is a valuable number. It does have its play, but remember, it's an estimate. You are looking at an internal rate of return. Often in venture, they are saying, hey, our estimated internal return for a certain period of time is this. And it may not be recognized. That's not a recognized return. That's a current. They've marked up the companies in their portfolio. That hasn't been realized. They haven't sold those companies, but it gives you an idea of, hey, for this period of time, given our best estimates of valuations within a portfolio, this is, the return for that period. And then some people can use it as a forecasting estimate as well. Gross return. Most people are probably aware of this one. This is pretty common in these days. And we'll walk further on, sort of how to take gross return and think more about it. And then next one, everyone's, always hunting for at least is net return. So wait a second, I take my gross return and then I adjust for any fees, taxes, and, and we'll talk a little bit about that triple net of, well, now inflation. So these are the types, and there's other types that you can run into. So you really need to dive in and understand, well, there again, who's calculated it, how it's calculating. And the manager should be able to walk you through that in nauseating detail. If they can't, that's a good sign that you're probably not talking to the right fund or the right manager. All right. So performance assessment. You sit down, you're looking at a return stream for a fund. Okay, wait a second. Where do I start? And these are 3 areas where you can really dive in and start thinking about, okay, let's start with performance measurement. How is it calculated? What is the performance? That's actually where most people feel comfortable. And that's kind of where most people stop, unfortunately. Next phase is, wait a second, let's break this performance down. That's called an attribution. Where and what within the portfolio generated the return? And this is where this gets into a little bit more of analysis. You've got to get a little bit more transparency from the manager. And really good managers should really already have some form of attribution that they could share with you. But this is that breakdown and understanding what's generating the return. Next, well, we've done our general measurement. We've broken down the source of return, but let's now dive into the analysis and appraisal. You now need to generate questions and, relate that quantitative analysis, which is the mathematical side of looking at performance, with, wait a second, what did this fund say they did? And that's the qualitative side, matching that say and the do or the numbers to the story. And does it make sense? That's the analysis and appraisal part. Now, I mentioned here benchmarks. It's tough to do a performance measurement aspect without some type of reference point. So one of the things that most institutions do, and I find, a lot of other people don't because it is difficult, is assessing, well, what's a best benchmark? What am I comparing it to and why? To give me a reference point. Because you got to remember, most of these private funds that you're doing performance assessment on, you're paying a fee. You're paying a fee for them to create some level of outperformance. Well, outperformance over what? Well, that would be the benchmark. Now, that can be, potentially, that could be, potentially, a public or private benchmark or, an excess return. And excess return is a return over that benchmark. So let's say the fund returns 10%. And the benchmark you chose for that period returns 8, well, then your excess return is 2. And then you can make an assessment there. Now, I got a little saying over on the side there, and some of you may have already read it, but I want to point it out for people who, maybe didn't focus on it. Most people feel like, hey, the performance is giving me some answer. A lot of the professionals that go through and performance measurement is important. What we found is more often it generates and is a tool to come up with other questions and then really go after and dive deeper and obtain transparency of where maybe the performance, attribution has some weird aspects to it. Maybe in the analysis part, the performance in, month to month doesn't match with what they say they do. Maybe they should have been counter cyclical to the market, but we had a gap event and, the market went down a lot and they went down a lot, but that's not really what should have happened. And I'll give you an example. In 2008, we had a lot of vol traders. They trading volatility, which is usually a counter cyclical. As the market, crashes, they do very well because, they're long chaos to say. But we had a number of managers that they had a few months where they were doing what they should. And all of a sudden they had a couple months where as the market continued to slide, they were posting negative returns. And that raised a question. Well, what happened? And so when we dove in and we talked to the manager, we realized they had actually sold their vol positions early and actually were flat and sitting in cash. So the protection we thought we had from that manager or the performance we thought we were going to see as the market continued to slide in 08 didn't occur. And so that gives you an idea of the things you can glean where, the manager got out early. They didn't necessarily do anything wrong, but we now understand why that fund didn't perform as expected. And we have the answers to that, which is important as an investor. It's your money on the line. So let's dive into performance measurement. One, you got to understand how it's calculated. You'll hear that's a recurring theme. And who's calculating it. I know a lot of people have fund administrators. So, like with the funds that I've worked for and now run, we have a fund administrator, an external third party, calculate all our performance. We obviously double check, run our own accounting, make sure it's correct. But at the end of the day, we accept their performance numbers so that is, can't be manipulated by the manager. It's a very big question is like, well, who's running valuations on assets? Is it just the internal team running valuations or do they have a third party, overseeing and having a process and procedure to valuation? Because valuations are going to affect how their performance is run. So very important aspect. You can have observable risks. Well, that's kind of looking backwards. It's not a bad thing to look backwards. I mean, obviously past performance does not mean, future results, but it does give you an idea of, well, what's the volatility or the standard deviation around, that fund's mean how has it performed over a number of different times? How did they do through maybe a negative cycle? That's always a good assessment. And being able to look back and then talk to the manager about that is very important. So, and a lot of these things you're wondering, oh my God, Chris, how am I going to calculate all this? A manager should have this for you. You just got to make sure that this is part of your questions of the things that you ask for so that you can better understand what you're looking at. And there again, if they can't come up with this, you're probably talking to the wrong person. Then you can calculate risk looking forward. This is a little bit trickier. This is something that's done very much at an institutional level, but one of the things that you can look at, and there's mathematical calculations like value at risk. I'm not going to go into that, but it gives you an idea of, well, what is the manager, or what do I assess is what I think may happen in the future, say economically? What's the probability of loss, given this strategy? And then next is, well, utilization of return ratios and risk adjusted ratios, and we'll walk through some of those later. They give you an idea and sort of a snapshot picture of maybe an easy percentage that's to understand. And maybe you have, other funds in your portfolio and you want to understand, well, how does this measure up? How does it fit my portfolio? Especially on the risk adjusted returns. I mean, if you're putting a portfolio together and you're going to add something new, you really want to make sure that this fund and its performance is not exactly what you already own, because then you're kind of piling onto the rabbit. You want to be able to identify returns that are generated from differentiated sources and creating a diversified portfolio. Performance attribution. All right. I'll give you an example. I mean, up there it says the answer, and this is the answer. The question is how were the returns generated? And I'll give you a long short hedge fund example. So long short, the definition of that is they have a side of their portfolio that is long stocks, and they have a side of their portfolio where they have shorted stocks. And generally, for people who are not familiar with shorting, is you're selling something you don't own, you borrow it, and you're kind of hoping it goes down because at some point you're going to have to buy it back. So the short side of your portfolio is really things that you think are going to underperform, and the things that you're long, you think they're going to outperform, and then that net return of those two sides would be the return of the portfolio. So in attribution, if I want to understand how their long portfolio did and how their short portfolio did, I could actually ask the manager for, hey, please send me the return streams for either one. And I could walk through and understand, hey, what was the add to the portfolio on the long side? What was the add to the portfolio on the short side? And did it really mesh up to where when the portfolio saw weakness, how did the shorts perform? Did they actually, not only dampen, volatility of the fund, but actually add a positive return? So that's a quick example of what I mean by attribution, is breaking apart the pieces of how a manager, puts together their portfolio, so you can have this deeper dive into what is actually behind that net performance number that you're seeing maybe monthly. This process will help show risks. It'll show where things maybe in a more granular way didn't match what the manager said. So it gives us, that, like it says, there's, what was generated by the manager selection and what was the portion generated by the market or the benchmark. So once you've picked a benchmark, and we'll talk a little bit more about that later, you can get an idea of, well, wait a second, the benchmark for a given month in that long short portfolio example, say his long portfolio. Well, the Russell 2000, let's say I'm dealing with the long short, small cap manager. The Russell 2000 in that particular month, well, it was up 5 and the fund's long portfolio was only up 2. Well, that would give me an indicator of, okay, given, the correlations between, the index that I chose, hopefully it's what they call best fit, and the fund, well, the fund underperformed. That might be an indicator of walk up to your manager and dive in and say, what kind of happened that month? What really drove that underperformance? So those are the kinds you can kind of, think in and dive in. You can also assess skill. How much was the, implied, it implies that the manager, had a high probability of superior performance. Well, you want to assess skill, and performance measurement allows you to dive in and see, wait a second, did this guy under or overperform on a consistent basis as you're going through this attribution? And it'll give you an idea because there's a simple fact. If they continually outperform on sort of this micro analysis aspect of, say, month to month, well, when times get tough, they're more likely to have solid performance during those times and going forward. It's just what we've seen in the thousands of managers that, I've been through, is those guys that can really say, hey, this is a continued skill aspect, not luck or not market driven. I'm not just riding the market. Those are the people that are going to, be there for you, in the good times, they're outperforming. And in the bad times, they're going to, put up some decent numbers on a relative basis. And as I said there, and I've said it before, the manager should be able to walk you through a lot of this, depending on the type of the fund. In a simple fund, like what I run is, private debt, I don't have a lot of breakdowns. But as you look at other, venture, hedge funds, other aspects that have multiple, drivers to their performance, you want to dive in and really understand that. So now that we've gone through, we've looked at general numbers, we've done our attribution. Simply put, you now need to go through and understand, after you've read the PPM, after you've read through the deck, and maybe you've had a conversation with a manager and heard their story firsthand, does everything make sense? And I'll be honest with you. I mean, I've built operational due diligence platforms, and everyone, out of 2008 and into 2009 and 10, they really thought that was going to be the way to catch frauds or identify people doing something wrong. It's just not what happened. Most of the scary things or the questionable things that we found about a fund was actually through this phase of performance analysis. After we've done the attribution and we think we understand what they're saying they do, and you look at the numbers and you're just like, wait a second, this does not match. This is something where they're doing something different than what they said. And sometimes it's a style drift. Sometimes, we ran into one fund that was supposed to be in equities and added real estate in the mid-stride. And so for about 6 months, their performance was off. It wasn't a bad performance. It just wasn't what was expected. But that's a problematic when you think somebody's doing A and you find out that they drifted into B. As an investor, that may not be an exposure you wanted, or maybe that's increasing the exposure that you already had somewhere else in your portfolio. So that's a problem. And you need to ask the question of, well, how often does he do that? How often does he go off the rails? And, he may still have made money. It may have been a good choice, but it wasn't a choice that you thought you were making by investing in that manager. All right, benchmarks. Why use benchmarks? As discussed earlier, you need some type of relative starting point. You can find a benchmark of, say, you're in one long short manager or one private debt fund, and great, I've got 2 or 3 that I like. You can, in your own book, build some of that. Hey, the managers I already own, understanding there may be some difference. That's why you would invest in a different fund, but it's close enough to where, are they outperforming, underperforming the funds that I already own? That could be, against peers. That could be one idea of a benchmark. More commonly is most people will try to find a comparable public market instrument, something that I could invest in, indices or a combination of indices that best matches, this alternative fund. Why you do that is because one of the classic questions is, well, wait a second. If I could just go invest in a public instrument, have liquidity, and I'm outperforming by putting that portfolio together over this fund, well, then that leads to the second one is, well, are they adding value? Is there an excess return for the fees that I'm paying to this manager? Or could I simply just go create something through a single index or a basket of indices or instruments that would mimic this particular alternative investor? And that's why you kind of have to, and the last little bullet point there, benchmarking is not easy. It is an art. It is very heavy in math. If you want to do it correctly, you can kind of put your finger up in the air and sort of say, okay, approximately this is what it looks like. And, but at an institutional level, you are trying to define what they call best fit. And that's coming through a process of regression analysis across, some of the funds that we ran, we would run them across 700-800 different indices to create a custom investable index that best fit say a fund, and we'd have 10 years of history to look at. So you got a lot of numbers to try and come up with. And then you kind of match that say and do again to what the manager told you to ensure that benchmark's really matching up. And so sometimes you'll see people, you got a debt fund you're looking at and someone's like comparing it to the S&P 500. Okay, that's an apples and oranges. That's not the best fit benchmark for a comparison of excess return. Now, that's not a bad comparison if you're saying, hey, how does this fixed income line up against the S&P 500? Because we all saw what happened in 2022. Wait a second, fixed income can trade in the same direction as equities. But how did this manager do? Were they counter-cyclical to that downward move? And why? So you can do a comparison against equities for a variety of different ways. You don't have to have that best fit. Maybe someone's looking at like, well, if I add this, I have a portfolio that's mostly S&P 500. Well, if I add this new fund, what would be the impact to my portfolio? Does it have low correlations? Is it counter-cyclical to the S&P? So, there are reasons why you might not have best fit, but generally benchmarks, you want to compare apples to apples. It'll give you the best idea of that excess return. And if that manager is creating a decent, performance stream. A little extra complexity is, performance assessment can change by investment type. And I mentioned this a little bit. If I'm going to look at a long short hedge fund, how I look at that is very different than how I would look at the IRR aspects and return streams of a venture fund, or say I'm going to go and invest in a single real estate asset, some multifamily or storage or something. I mean, the way you're looking at numbers and how they're presented are going to be very, very different. And so you have to differentiate how you're approaching performance and your assessment and your attribution, based on the asset class you're looking at. Investment style. How you look at high turnover is going to different from things that you would hold for a very long period of time. And then even types of investors. How I may have looked at it working for a large fund of fund with institutional clients like endowments and pensions is one way, and how a family office or an individual might look at it could be different. And why I throw individual in there is, doing due diligence and running through performance. It's time. It's a task. It takes a lot of time, and you don't have systems and 9 people working for you all doing this. It may be just you. So you've got to make an assessment of what am I investing in? What's my important aspect? And how do I really want to best look at performance measurement that meets my guidelines and allows me to do the proper risk assessment and make sure that I'm making a more intelligent investment. And that's very individualistic. And so I know a lot of different people have tried to come up with a variety of different ways for themselves, because maybe you work all day. You don't have all day to do this and then do it at night as well. Return ratios. I'm not going to go into these too much. These are a variety of return ratios you might see. They cover, this is a whole nother description. I just wanted to show this quite quickly about, hey, I'm looking at risk adjusted returns. I'm looking at, my return on investment. There's a lot of different metrics you can make as further assessments and sort of measure up how that manager might be doing depending on what they own. And you got to be careful. Like I see some people trying to use Sharpe ratios for illiquid investments. Bill Sharpe, when he invented that ratio, was not meant for that. It was meant for more looking at public, instruments. And so if you use something like a Sharpe ratio to calculate and measure a private debt fund, for say, you're going to get some wonky numbers. And there again, you got to make sure you're looking at apples to apples. And we can have, if someone wants me to come back and talk about ratios and things like that at a later time, we can definitely have a quick little like, hey, here's 10, 15 minutes diving into, various aspects of how to use that stuff. We can come back and do that. I mentioned leverage here. People are like, well, what the hell does that have to do with performance measurement? And well, actually a lot. Leverage is a two-edged sword. It can actually enhance or hurt your return. So it's something you need to understand that's in the portfolio. How much leverage does the fund use, or do they use none? And you need to take the time to dive in and say, well, I need to understand what is the leverage agreement you have with, say, a bank. Because kid yourself not, the risk you're taking is not so much just the leverage of, oh, does it work for me as things are going up, or does it work against me as things are going down? It also puts you in a position of where you've taken operational risk, you've taken a counterparty risk. You can see in that bottom quadrant there. And counterparty risk is not a risk you're compensated for. So adding leverage, it can affect the numbers, but it also can affect the qualitative assessment you're making on this fund. And that's why I threw it in here, because this element really hits not only the quantitative looking at the numbers, but it also can affect the qualitative aspect of the risk you're taking. Because let's say that bank fails. I mean, go talk to anybody who had Silicon Valley Bank as their primary bank earlier this year. It was a risk they certainly were not compensated for. I know a lot of venture funds, and I helped a lot of people try to secure other bank accounts as fast as they could. And one thing I always ask is, why are they using the leverage? I have this motto, in certain strategies, you need leverage to make it viable. And so be aware of that. So leverage is not always a bad thing. But if you're in a strategy where the trade doesn't work without leverage, maybe that's more risk than you're willing to take. And you're only going to get that by understanding this component. Here we talked a little bit about, I was at a conference and people were talking about the triple net return now. So everyone's, like I said, familiar with gross returns, and, now you can't even, you're not supposed to show gross returns. They should be showing a net return to you. And so that's minus all expenses, usually encompassing management fee, and if there's an incentive fee or not. And then minus fund expenses gets you this net return. And then a decade ago or so, a lot of people started thinking, and most of this sort of trickled down out of the family office world, was, wait a second, I pay a lot of taxes. I'm high net worth. I'm always in the top tax bracket. Well, what's my return from your fund, tax adjusted? And that's a very individual number. Most funds will not show that, because that's actually going to be a different number for every particular investor. But it's something, if it, hey, what is the tax impact of the fund I'm investing in? And knowing your tax bracket, you can calculate that after tax return. Well, now the third leg that no one cared about for the better part of 12 years, because it was just not a factor. But now it is, and it looks like it's going to be sticky, and it's going to be around for an extended period of time. And if you're in my camp, I think the Fed has set themselves up with a very lofty goal of trying to get to 2% inflation. I don't know if they'll be able to do it or not, but right now you're looking at, inflation was never really an important part in this calculation, and it doesn't affect your, gross number. It's like, hey, I made $10. My net return was $10, but what's the purchasing power of that actual dollar? It's a further assessment that now can be quite material. Especially where you're looking at inflation right now at 3.2. And when people were making this assessment earlier the year, when inflation was close to 5, double digit returns, like a 10% return, was a break even on your purchasing power. It was pretty scary time for a lot of people, where they thought, hey, I made a 10% return on my fund, yet I only maintained, the ability to, tomorrow to purchase the same amount of goods. That was a big shock to a lot of people. So we sort of said, hey, if you have the time and that's of interest, and you're in that situation of where, hey, inflation is, you should take a little bit of time and say, okay, am I at least creating a portfolio that's maintaining its purchasing power? And, the definition of that is, your real return. So I just wanted to bring that up. It's a new way to assess things. It can kind of give you light of, well, how are you building your portfolio and what's in your portfolio? Because right now, using just traditional investments, long stocks, long bonds, if you go through this triple net, you're not maintaining your purchasing power. I haven't seen anybody come up with, and I've talked to a lot of RIAs, they haven't come up with a combination of traditional assets and investments that is maintaining, the purchasing power of people's dollars. So it's led to where a lot of people are now looking at alternatives, both on the equity side and the fixed income side, to find new ways to diversify their portfolio, but also enhance their return to hopefully get to the point where they're still generating actual real return, or they're at least maintaining their purchasing power. So something to think about that. Lastly, this is just real quick. As I stated earlier, I run a private debt fund, and we do microbalance commercial real estate loans. So if you want to talk further about that, that's the company I'm currently, managing with my partner, my team. And there we go. I know that was a quick overview. That was what it was meant to be. And hopefully in the future, we can dive deeper into a number of those subsections, maybe even run an example of, attribution on a long short hedge fund. But that'll have to be for, a later time and another conversation. But hopefully this was very helpful and gives you a way to think about what you're doing when you look at performance. It's more than just the return they're saying they put up. You can really glean a lot. So if you want to reach out to me and talk further about performance, or you want to talk about something in specifics to, the group I work with, you can, reach out to me on website. I'm on LinkedIn. Feel free to ping me. Love to talk. All right,
Thank
and
you very much, Chris. Yeah, that was awesome. And you're right about saying how this is more to take information back and kind of think about it.
There's a lot to think about. I mean, I covered a lot very quickly. I always wish I had more time, but
no, it's certainly
we'll circle back maybe if there's further interest on, diving into certain splinters of performance measurement.
For sure. No, but thank you for that. I'd like to ask everybody who's here with us, if you have any questions for Chris, feel free to post them on the chat. I'm gonna now myself go ahead and go through a couple of slides of information and quest events that are coming up that I'd like to share with everybody. So let me do that, and then we'll bring you back up, Chris, for final questions and goodbye. So one moment, okay? So, of course, starting with our disclaimer, every material shared here today is for educational purposes only. Quest does not provide any tax, legal, or investment or structuring advice or endorse any type of product, services, or investments of any type. If you need, we highly encourage you to consult with an attorney, accountant, financial advisor before entering into any type of investment. If you are thinking of investing with your self-directed IRA, if you have questions on how that goes, if you want to invest in a private hedge fund with some retirement funds, go ahead and scan this QR code and schedule an appointment with an IRA specialist so we can go over that with you. More than happy to do that. I'd like to also talk to you guys about our gold family experience. And if you're one of those clients who have multiple accounts and multiple investments, and maybe have family that you like to bring on, you really maybe benefit from this, from joining this service that we offer here at Quest. It's more of a one-on-one concierge type of service. You have a dedicated team to support you. You have priority funding, priority processing. So it just comes with a lot of perks. You'll have also special events throughout the year just for you. So make sure to check this out if this is something that you think you may benefit from it. If you have questions, please let us know. We'll be happy to go over all the extra benefits from this event. We are going to have our next socials in person in Texas. So our Houston office, our Austin and Dallas office is going to be, the topic is the rental continuum. We're going to be decoding short-term, mid-term, and long-term rentals. This is also, of course, like always, a great opportunity for networking, to find your next deal if you're looking for that, or maybe to find your people to raise capital if you're looking for that as well. So if you'd like to register for these, we're super excited about these. They're coming up in November. So we still have about a month there, a little over that. But yeah, we're excited for these. The last time we had our social, at least in the Houston office, we had a great turnout. In the other offices too, but Houston, we had about 200 people. So really great opportunity to really network, get to know more people in the industry who are doing just what you're doing. Or if you have questions, it's a great opportunity to come in and ask different subject matter experts on different self-directed IRA investing topics. Okay. This year we have our QuestCon live, and it's actually free this year. It's going to be on November 17th, and all the event online. It's going to be with prominent women leaders in the industry. So it's going to be a great time to listen to them, to ask them questions directly as well. So if you're available that day, you don't want to miss this event. Again, this is the QR code to register, and again, it's free. So, and then finally, we have our Quest Expo that we're starting to let everybody know. It's going to happen next year in June. June 27th to 29th of 2024 is going to be in Dallas. If you attended our last expo, you know how great these events are, not just for networking, but for exposure, for just talking to a lot of vendors that are going to join us there, and just the topics and the speakers there are also, and panels are also great, amazing information. So, if you like to score early bird tickets, go ahead and do so. That's all I have for now. And Chris, it looks like not a lot of questions there, but
I told you that beforehand. Performance measurement is super important, but a lot of people are going to have to digest this and come back with like, wait a second, what did I just listen to, and how do I need to? How do I need to? Because one of the things that we didn't really get to cover is, and unfortunately, you just don't have time for everything, is some of the examples of implementation. It's a lot of what I talked about. Yeah, we can, like I said, we can maybe have a couple aspects of, implementation. I know a few hedge funds that would, they'd be up for it. As long as I redact their name off it, I can tear them apart. I've done it before. So, but yeah, and it'll give people a little bit idea of like, wait, how could I actually do this? Because it is daunting. I mean, I'm not going to lie to you. I mean, there's a lot of moving pieces to take performance beyond just a return stream.
Definitely. I put back your QR code if anyone wants to contact Chris directly. Here's this information as well. But thank you so much, Chris. This is awesome. Thank you for joining us, and for sure, hopefully we have you back here soon.
Appreciate the time. Thank you.
Into some of those other subjects there. But if anybody came in late or would like to catch a replay, we post everything on our YouTube channel and our Facebook page. But thank you, everybody who joined us. And thanks again, Chris. Hope everybody has a great day. Take care.